The United States government just scheduled an emergency meeting on critical minerals. Wednesday, February 4th. International delegations flying in from around the world. They're calling it the inaugural Critical Minerals Ministerial, hosted by Secretary of State Marco Rubio at the Department of State in Washington. Now ask yourself something. Why would the most powerful government on Earth convene an emergency international meeting about minerals the same week those minerals suffered a 41% crash? Mark here from GoFinance. What I am about to show you in the next 13 minutes is a timeline that will change how you understand this entire crash. Because while you were watching silver drop from 121 to 72 while every screen was red, while every headline screamed that precious metals were finished, someone on the other side of the world was buying that exact same silver at a 29% premium. They were not panic selling. They were paying more, calmly, deliberately, while the Western market was in complete freefall. Let me set the stage quickly because the crash itself matters, but what happened before and after matters more. Silver went from $30 in early 2025 to $121 by late January 2026, 300% in 13 months. Gold hit $5,595, both all-time records. The rally was fueled by central bank buying, de-dollarization, and surging industrial demand. But in the final weeks, something changed. Chinese speculators, retail investors, equity funds, momentum algorithms, they all piled in at the same time. Silver went up 54% in January alone. Every night while America slept, Chinese buying pushed prices higher. Every morning, Western traders woke up to find they'd missed a 3 to 5% move overnight. One strategist called it the most volatile month in precious metals history. The market wasn't trading on fundamentals anymore. It was trading on pure adrenaline. And here's the thing about adrenaline. Eventually your body crashes. Thursday, January 30th. Two things happened simultaneously. President Trump nominated Kevin Warsh as the next Fed chair. Warsh is a hawk. Higher rates, tighter policy. Precious metals hate that combination. And the dollar started strengthening. That was the pin that popped the balloon. Now picture this. Unless you were sitting at a trading terminal, you have no idea how fast this moved. Gold was at $5,595. 10 minutes later, it was down $200. $200 an ounce, gone in the time it takes to make coffee. But gold was just the tremor. Silver was the earthquake. The selling started in Asia. Chinese investors, the same ones driving prices higher every night for weeks, flipped. They started taking profits. And once the selling started, it fed on itself. Every tick lower triggered margin calls. Every margin call forced more selling. Every wave of forced selling triggered the next wave, a cascade, a waterfall, a chain reaction nobody could stop. One fund manager described watching his screen and feeling physically sick. Another said he'd been in commodities for 20 years and had never seen anything like it. The speed was inhuman. Algorithms were selling into algorithms. Humans couldn't keep up. By the time London opened, the damage was already catastrophic. Friday, January 30th. Silver plunged 37%, from 121 toward 75. The biggest single-day crash since 1980. 46 years. Traders called it a capitulation event. The word on every desk around the world was one word: bloodbath. But Friday was not the bottom. Over the weekend, someone decided to pour gasoline on a fire that was already burning. The CME group raised margin requirements on silver from 11% to 15%. Let me explain what that means. Imagine you bought a house with a small down payment. Saturday night, your bank calls and says, "We need double the deposit by Monday morning, or we take the house." You scramble. You can't find the money. They foreclose. Now imagine that happening to thousands of traders at the same time. Forced liquidation, prices falling further, which triggers more margin calls, which triggers more forced selling, a death spiral that feeds itself. Monday, silver dropped another 4%, hit $72, total damage from 121 to 72, 41% in less than 72 hours. Gold bottomed around 4,400, down 21%. Its worst crash in over a decade. Everything was red. Equities, crypto, commodities, everything. Now here's where every other video about the silver crash ends. They tell you it crashed. They tell you why. They tell you to be careful. And they move on. But not this video. Because I'm about to show you 3 things that completely change the narrative. 3 things that nobody else is putting together. Before we continue, if you're getting value from this breakdown, drop a comment below. Tell us where you're watching from. And what do you think? Why is the US government calling an emergency meeting right now? Subscribe to GoFinance if you haven't already. Now let's get into what they're not showing you. While silver was crashing, while every Western exchange was in full panic mode, I pulled up the Shanghai data. The Shanghai Gold Exchange spot price of silver, $111.86. Let me make sure that lands. At the exact same time, Western silver was trading at $78.88. Shanghai silver was at $111.86. That's a $22.98 gap per ounce, a 29.14% premium. The same metal, same chemical composition, same periodic table element. Two completely different prices on two sides of the Pacific. And the side that everyone assumed was panicking the most, China, was paying 29% more for it. Why? Why would anyone pay 29% more for something they could theoretically buy cheaper, unless the cheaper price isn't real? Unless the paper price is lying and the physical price is telling the truth? Unless the Western market is pricing paper contracts and Shanghai is pricing actual metal? But the numbers get even crazier. I went back and looked at the Shanghai premium chart over the past 12 months. Not the price of silver, the premium. Just the gap between what Shanghai pays and what the West pays. That gap has grown by 1,874% in 1 year. 1,874%. That's not a normal market. That's a market screaming that something is fundamentally broken. Now, here's the second thing nobody is showing you. On the Shanghai Futures Exchange, every single silver contract hit limit down. February contract, minus 20%. March contract, minus 20%. April contract, minus 20%. All the way down the curve. Every contract locked, frozen. Circuit breakers triggered. You couldn't trade even if you wanted to. But here's the part that should make you stop scrolling. Convert those limit down prices to dollars. The SHFE February contract at limit down was $94.97. Western futures were at $78.88. China's crash price, their absolute worst case scenario floor, was still $16 higher than where the West was freely trading. Their floor is our ceiling. And China wasn't just watching this passively. They intervened hard. 5 commodity funds suspended from trading, not limited, fully suspended. The UBS SDIC Silver Futures Fund was shut down for the second time in 12 days. 16 traders barred from opening positions or withdrawing money for an entire month. Position limits slashed. They threw everything they had at cooling this market. And yet, after all of that, silver bounced from 72 to 85. The floor held. Now here's the question that should keep you up at night. The Shanghai Exchange had already started tightening rules on January 27th. 3 days before the crash, they widened price limits, raised margins, reduced positions. They were preparing. If they saw this coming, who else saw it coming? And that brings me to the third thing. This is the one I saved for right now because you needed to see everything else first. JPMorgan, the biggest bank in America, one of the most powerful precious metals traders on earth, recently moved their gold trading desk to Singapore, not expanded, moved from Manhattan to Singapore, right in the heart of Asia, right where physical demand is surging, right where central banks are hoarding, right where the premiums are 29% above Western prices. You don't move an entire trading operation across the world on a hunch. You don't relocate your people, your technology, your entire operational backbone to the other side of the planet because of one quarterly report. That's a multi-year, multi-million-dollar strategic repositioning. You do it because your smartest people have looked at every piece of data and concluded that the center of gravity for precious metals has permanently shifted east. JPMorgan looked at Asian physical demand. They looked at 14 months of Chinese central bank gold buying. They looked at COMEX disruptions. They looked at Singapore becoming the new hub for gold trading and tokenized assets. And they made a decision. Be where the market is going, not where it's been. It's like watching a billionaire quietly sell his Manhattan penthouse and buy farmland. You don't ignore that. You ask, what does he know? Now, let me connect all of these dots. The Shanghai premium, the limit down data, the fund suspensions, JP Morgan's move. Individually, each of these facts is interesting, but together they tell a story that changes everything. And this is where Wednesday's emergency meeting comes in. And honestly, this might be the most unsettling part of the entire story. About 75% of you watching aren't subscribed. If this unfiltered analysis is cutting through the noise for you, hit subscribe. Drop a comment below and tell us, do you think Wednesday's meeting changes anything? I'm here for those who want clarity and substance, not polished hype. Now let's talk about why this meeting matters. Wednesday, February 4th, 2026, Secretary of State Marco Rubio is hosting the inaugural Critical Minerals Ministerial at the Department of State in Washington. International delegations from around the world are flying in. The official statement says they're gathering to advance collective efforts to strengthen and diversify critical mineral supply chains. If you speak government, you know what strengthen and diversify really means. It means we have a problem. It means we're dependent on supply chains we don't control. It means we need to fix this before it becomes a national security crisis. And here's why silver matters in this context more than any other mineral on that list. Silver is not jewelry. It's not coins. It's the backbone of the modern technology economy. Solar panels cannot be made without it. Electric vehicles use it in every electrical contact. 5G towers need it. Semiconductors need it. Advanced military systems, from guided missiles to satellite communications, depend on it. Medical imaging equipment uses it. Your smartphone has silver in it right now. Here's the number that should scare every policymaker in that room on Wednesday. The world consumed 680 million ounces of silver for industrial use in 2025. That's 60% of all silver demand going into things that get used up. Gone, not sitting in a vault, consumed. And the world has been running a supply deficit in silver for years, using more than it mines, every single year. The only thing filling that gap is drawing down existing stockpiles. And those stockpiles are running out. You can't fix this quickly. Most silver isn't mined on its own. It comes as a byproduct of mining copper and zinc. There are very few primary silver mines on Earth. Opening a new one takes a decade. A decade. So even if silver went to $500 tomorrow, new supply wouldn't arrive until the mid-2030s. That's the structural trap that makes silver different from almost every other commodity on Earth. So think about what could come out of Wednesday's meeting. Government stockpiling programs where the U.S. starts buying and storing physical silver the way they store oil in the Strategic Petroleum Reserve. Export controls similar to what China has already done with rare earths. Bilateral agreements with allied nations to lock up supply. Tax incentives for domestic mining. Restrictions on foreign acquisition of silver reserves. These aren't theoretical ideas. These are exactly the types of moves governments make when they realize a commodity is too strategically important to leave to traders and speculators. China already made their move years ago. They have export controls on critical minerals. 14 consecutive months of central bank gold buying. Strategic reserves being built across multiple commodities. They restricted rare earth exports. They limited gallium and germanium shipments. They're methodically, systematically locking down the physical resources that the modern economy runs on. They're playing a 50-year game while Western financial markets are playing a 50-minute game. China is securing actual atoms, actual metal, actual physical supply, while the West trades paper promises for those same resources. And now it appears the United States is finally waking up to this reality this Wednesday. Now let me give you the timeline one more time, and I want you to feel each entry, not just read it. Late January, silver 121, gold 5,595, all-time highs, euphoria everywhere. Friday, January 30th, silver crashes 37%, gold drops 9%, panic. Weekend, CME raises margins, the hammer drops, forced liquidation begins across every major exchange. Monday, February 3rd, silver hits 72, total destruction, 41% gone. SHFE silver limit down across every contract, 5 funds suspended, 16 traders banned, and Shanghai still paying a 29% premium. Tuesday and Wednesday, something shifts. Silver recovers to 85. Gold climbs back above 4,800. Buyers return. The floor holds. Wednesday, February 4th. The United States hosts an emergency critical minerals meeting. Same window. JPMorgan moves gold desk to Singapore. Look at that timeline. Look at every single entry. And you tell me that's a coincidence, because I've stared at it for hours and I can't make it feel random no matter how hard I try. Now, let me bring in a perspective that adds a critical layer to everything we've discussed. Ray Dalio, one of the most successful and respected investors alive, founder of the largest hedge fund in the world. Dalio recently said something that stopped me cold. He said, something needs to prick the bubble to cause a market crash, and at first you might think the silver crash is that prick. But then Dalio said something crucial. He said, historically, what ended overvalued markets was something that led to sustained outflows of cash, rate hikes, quantitative tightening, month after month of cash being pulled out of the system. That's what kills bull markets, not one event, not one crash, a sustained mechanism that drains liquidity. And right now, rates are still more likely to go down than up. Even with Warsh coming in, the Fed is still on track to end quantitative tightening. The market is adjusting for a slightly less dovish Fed. But Dalio's exact words were, the pricking we need to trigger a crash is still not here. Think about what that means. Imagine you're driving at 100 miles an hour. Someone taps the brake. You slow to 95. That's what the Warsh appointment was, a tap on the brake. Silver reacted like the car flew off a cliff. That massive gap between the size of the trigger and the size of the reaction tells you everything you need to know. It wasn't the foundations that cracked. It was the speculators, the leverage, the froth, the weak hands. They got destroyed violently. But the road itself, the fundamental case for precious metals, did not change, not even a little. Remember the 1970s. Gold surged from $40 to $200. Everyone was euphoric. Then it crashed 50%. Headlines wrote obituaries for the bull market. Analysts went on television and said it was over. Done. Finished. Regular investors who had put their savings into gold panicked and sold at the bottom. They took the loss. They moved on. And then gold went to $800. From $200 to $800. The people who sold during the shakeout missed a 400% move. One of the single greatest wealth creation events in modern financial history. The crash didn't end the bull market. It ended the tourists. The The speculators, the weak hands, the structural trend continued without them. The people who understood why gold was going up in the first place, the ones who weren't just chasing momentum, they held, and they were rewarded beyond what anyone thought was possible. Now, look at silver. It went from 30 to 121, crashed 41% to 72, and now it's sitting at 85. Gold went from 5,595 to 4,400. Now it's above 4,800. Both metals bounced. Both found a floor. That's not what dying assets do. Silver bounced from 72 to 85. That's 18% from the lows. In 2 days, gold bounced from 4,400 back above 4,800. When a bubble truly pops, when something is genuinely going to zero, you don't get an 18% bounce with conviction. You get a small bounce and then a slow grinding bleed downward for months or years. The dot-com stocks didn't bounce 18% after the crash and hold. They bled for 2 years. Silver bounced and it held. Gold bounced and it held. Real buyers were waiting at those lows. They looked at the supply deficit. They looked at 680 million ounces of annual industrial demand. And they said, this is too cheap. We're buying. That's not hope. That's a signal. Now here's what I'm watching this week, Wednesday's minerals meeting. If that meeting produces any language about government stockpiling, if they announce any new bilateral supply agreements, if there's any mention of silver specifically as a strategic resource, that changes the entire calculus. Because government buying is not speculative demand. It doesn't panic sell on a Friday. It accumulates over years. Watch for the official statement after the meeting. Watch for any executive orders in the days following. And watch the Shanghai premium. If it stays above 20%, even as Western prices recover, that tells you the physical market is sending a message that the paper market hasn't received yet. I'll be covering all of it on this channel. Do your own due diligence, understand the risks. This is not financial advice. Never invest more than you can afford to lose. But if you're asking why the US government is calling an emergency meeting on critical minerals the same week silver crashed 41%, now you know what to look for. Drop your take in the comments. Is this the end of silver or the setup for something much bigger? This is Mark from GoFinance. Wednesday follow-up coming after the meeting. Stay sharp.